When most people think about real estate investing, they think, I'm going to go out and buy this property for $200,000, which yes, it is possible if you do a little bit of digging. And then I want to go out and sell this property for $300,000. But that's not what I said. I said cash flow producing real estate. This is speculation. We don't know where the housing market's going to go tomorrow. Instead of trying to sell this property for a huge profit, when I talk about cash flow producing real estate, I mean going out and buying a property not for you to go out and live in, but for you to rent out to somebody else. So now you buy this house and now you're going to rent it out to a nice family. And maybe they'll pay you $2,000 a month in rent. Now this rent income that you're generating should cover your expenses. That includes your property taxes, your insurance, your maintenance costs, your management fees, because I don't want you to be the one that's unclogging the toilets at 2 in the morning. You want a manager who's going to handle all the day-to-day work so it can be passive for you, cover your vacancy expenses and your mortgage if you have one, and then put some money in your pocket every single month. So let's run some numbers. If you rent this property out for $2,000 a month, that means this property can generate $24,000 a year. But you don't get to keep all that money. You got to pay all your expenses. Remember the property taxes, insurance, maintenance, management fees, and your vacancy costs. Let's assume that those 5 costs charge you $10,000 a year. That means you are profiting $14,000 a year. And I'm going to assume for the purposes of this example that you're not getting a mortgage, just to keep it simple. If you make it $14,000 a year, the question is this a good deal or bad deal? And the answer is it depends. For me, what I like to look for is a 7% cash on cash return. Meaning for every dollar that I invest, I get 7 cents of cash flow without having to see any appreciation. So if I take $14,000, I divide it by $200,000, you can do it on the calculator, this gives me 7%, meaning this hits my threshold for cash flow. Some of you might say, well, Jaspreet, I'd be okay with 5%. Others of you will say, well, Jaspreet, I need at least 10%. This cash on cash return generally also goes hand in hand with risk. The higher the cash on cash return, oftentimes higher the risk. The lower the cash on cash return, the lower the risk. In the commercial real estate world, this number is called your cap rate. So if hypothetically you were able to find a closet for sale in Manhattan for $200,000, you probably wouldn't be able to rent it out for $2,000 a month. You'd be renting out for a whole lot less because the cash return that you'd be getting in Manhattan is much lower. You're not seeing 7% returns, you're seeing 1% returns, maybe 1.5% returns because there's so much demand to buy in that area. Versus if you go into rural Idaho, now you might be seeing 10 or 11 or maybe even 12% returns because there's not as much demand, more risk, and you might have a tougher time finding a tenant. Now, real estate investing is not going to be for everybody, but the reason why I like to talk about it so much is because when you invest in real estate, you get 3 benefits. Number 1, you can generate this type of cash flow, which is a nice type of passive cash flow when you have a good property manager. Number 2, you own a hard asset, something that you can see, feel, and touch because I own the land, I own the building, I own the bricks. And number 3 is you get a ton of tax breaks. As an attorney, who's not your attorney, what I can tell you is that real estate comes with the biggest and best tax breaks that our tax code has to offer. So even though you're making this money every single year, you can pay little to no money in taxes legally, which is why some real estate investors are making millions of dollars a year, paying little to no money in taxes because that's what the IRS says. Investment number 2 is the cash flow producing business. Here's the reality that most people don't want to talk about. In our economic system, the way you build wealth is about being an asset owner. If you live in a first world country like America, you have to be a business owner if you want to build wealth, period. Now, that doesn't mean you have to go out and start a business. This doesn't mean you have to go out and operate a business, but you have to own a business if you want to build wealth because that's how our economic system is designed. So when I talk about investing in a cash flow producing businesses, I'm going to break this up into 2 parts. One is the business you operate. This might be you actually going on starting a business, which is not for everybody. In fact, it's not for most people. And then the alternative is investing passively, which would be like investing in a stock that's paying you with cash flow. Let me break this down, but I want to remind you that if you are an investor and you want to stay up to date on what's happening in the financial markets, my team at Briefs Media publishes a free daily newsletter where we break down what's happening in things like the stock market, the housing market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read newsletter. It's completely free. We have hundreds of thousands of investors that are reading market briefs every day. So if you have not joined yet, well, I got the link for you to join for free down in the description. below. There's a big difference between working in a business and owning the business. I'm an employee at Briefs Media. That means I'm entitled to a salary. But the owner gets the profits. I am also the owner of Briefs Media, so the profits come to the owner. If you want to get access to those profits that a business has, you have to be an owner. And the difference between an owner's profits and your salary is capped. It's capped based off of whatever your salary is and maybe whatever raises that you get. There's no cap on profits. If you own a piece of a company, you could have unlimited profits because there's no limit. The simplest and most accessible way to do this is just to take some of your extra money and invest your money into a company that's paying out a dividend. This means you're investing your money into a company that's making a lot of profits, and now when they have all this excess profits, they just give it away to the shareholders, people like you who own a piece of the company. So if you go out and you buy one share of, say, McDonald's, you become one of the owners of McDonald's. Now, you don't get to tell McDonald's what to do, although you do get voting rights, but you are entitled to your share of profits because you own one piece of the McDonald's pie of ownership, because you own one share. And because you have that, when McDonald's has this big profit at the end of the year, they give a big chunk of it away. In 2024, they gave away about $5 billion. You're going to get your piece of that. One share out of the many millions of shares that they give out dividends to. Now, not every company pays out a dividend, and I'm not going to talk about which stocks pay dividends in this video, but instead, I want to talk about funds. Because if you start investing in McDonald's for the dividends, and then they start creating bad burgers, and then they go out of business, you would lose all your money. And you would also lose your future dividends. So higher risk, higher potential return. And for today, let's talk about investing in funds, because there are baskets of stocks called funds that you can invest in specifically with the goal of generating dividend income. I'll give you a few examples. NOBL, SCHD, and VYM are three different ETFs, meaning funds that specialize in investing in dividend-paying companies. NOBL is a fund that invests in S&P 500 dividend-paying companies. The S&P 500 is a group of the 500 largest companies in the stock market. Some of those companies pay dividends. That's what NOBL focuses on, but they take it one step further. They only invest in the companies that have paid out and increased their dividend every year for the last 25 years. So in order to be in this NOBL fund, you have to be an S&P 500 company. You have to pay out a dividend, and your dividend has to have gone up for at least the last 25 years. That's the companies that you invest in if you invest in this fund. SCHD and VYM are two funds that I am personally invested in as a disclaimer, and these are two funds that invest in high dividend paying companies inside of the United States, which SCHD is created by a company called Charles Schwab, VYM is created by a company called Vanguard. So if you wanted to invest in companies, into stocks that pay out dividends, and you don't want to try to find the perfect company, one alternative is you can invest into a fund. Now, I'm not telling you what to invest in. You got to do your own research because I'm not a financial advisor. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so you need to always do your own due diligence and never blindly trust a random guy on YouTube. Now, the thing you want to remember here is when you get paid with dividends, you're going to have to pay taxes. And so when you buy this, what you're essentially doing is every time you buy a share of any of these dividend-paying funds, you're buying a machine that's paying you with cash flow. Every dollar you invest is a dollar that's going to pay you with a little bit of cash flow. And then you have the opportunity to reinvest these dividends as well. Because when you get paid the dividend, many brokerages will allow you to just automatically reinvest that money. That way, now your money that your money made can make you more money. So you go to work to make some money. You take some of the money and you buy some cash flow producing machines. So you buy some cash flow producing dividends. Then as you get that cash flow back, you can reinvest the cash flow to make you even more money. That way now you're working hard to create some more cash flow, and your cash flow is also working hard to create you even more cash flow. That way you can build this bigger and bigger snowball that's working to produce more cash flow for you. This is the passive way, and when you think about taxes, you have to remember that even if you reinvest that dividend income, you still have to pay taxes on it. Although the nice thing about dividend income is your tax rates are generally lower than the tax rate you would pay from your job if you earned that same amount of money, because the tax code incentivizes you when you make your money from your investments, and they kind of punish you when you make your money from your job because, well, when you're an investor, you qualify for lower tax breaks and higher tax rates. But it gets even more interesting when we talk about operating your own business. Because now, if you can build your own business, which I get it is not for everybody, you have the ownership of that company. And as your business starts to grow and you pay yourself a salary, well, remember, the profits that the company makes go to the owners. So if you own the company, you get to make the profits. But this is where also the tax code can be very interesting, because you as the business owner are allowed to deduct what's called ordinary and necessary expenses. So what's ordinary and necessary for your business? Well, if you have a digital business and you have to, say, travel to Hawaii for 2 weeks for business, maybe you have to have some meetings out there, maybe you have to record some videos, maybe you have to go out and look at some real estate, but if you have to fly out to Hawaii with your business partner, who happens to be your wife or your husband, now that flight to Hawaii is a business expense. It's ordinary and necessary for your business because you need to go to Hawaii. And while you're there, you need a hotel. And while you're at the hotel, you also need meals. And maybe you need to have some events that you need to go to. You can start to see how these things can become business expenses because it's ordinary and necessary for your business. I'm telling you this because these were things that were never taught to me. When I was growing up, I did not travel a lot. When I talked about traveling as a kid, most of the time it was just me going to India to visit my family. Well, as I started to see some success in my business, I started traveling a whole lot more with my business partner, who happens to be my wife. So there were times where we lived in California for a month because I needed to for business. I was speaking, I was doing podcasts, and I was doing a lot of stuff out there. I lived in London for a little while for the same reason. I was speaking, I was doing podcasts, I had meetings. I lived in New York for a little while for the same reasons. Those trips then became business expenses with my business partner, who happened to be my wife, because it's an ordinary and necessary expense from business. In fact, sometimes it gets even more wild because I remember one year my accountant calls me and he says, "Jaspreet, how do you feel about G-Wagons?" I said, "G-Wagons? Well, I don't know, I don't really care. What do you mean?" He says, "Well, I think you should go out and buy a G-Wagon." I said, "Why?" He said, "Well, the government has a program going on right now where they will give you a bonus depreciation, meaning a bigger write-off if you go out and buy a heavy vehicle like a G-Wagon for your business." And I said, "Well, why do I need a G-Wagon for my business?" He said, "Well, you're an influencer. And because you're an influencer, you might need a G-Wagon to maintain your image as an influencer." I said, "Is that real?" He said, "Yeah. People are doing it all day and night long." Now, I did not go out and buy a G-Wagon because I'm not going to go out and spend money on something that I don't need just to save 30 or 40% in taxes. But you can start to see how the tax code can benefit you when you also operate the business as well. Is it more risky? Absolutely. Is it more work? Absolutely. But this is the game that wealthy people are playing. And now that you understand this, the question is, what are you going to do? Is it easy? No. But the opportunity is there. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.